Are we live yet? Perfect. All right. Welcome, everybody, to Eurodollar University's, I guess it's October webinar, our fall webinar. We're going to go through the hidden truths behind interest rates and a whole lot more. We're going to figure out why it is that it's so difficult to understand what the worlds are doing, what the market's doing, and everything else in between. That's one of the things you keep coming across, and I'm sure a lot of people are feeling the same things. That's why you're here, is that you hear so many things from, floating around the mainstream media, and it's really one of those things where everybody says this, therefore we're supposed to accept that it's true. You never really think much about it or trace back to where these everybody says comes from. A lot of times it comes from either economics or central bankers, and usually central bankers who are practicing economics. So we're going to try to get to the bottom of this to understand what the markets are saying, because the markets are very often saying something that economists and central bankers aren't either expecting or they don't actually like. So there is a wealth of hidden information that's available that you never ever hear about because of that fact. And so we'll uncover this through some really concrete examples of the past, and then we're going to finish off with a bit of a mystery here, because we've got some pretty striking, compelling signals from the marketplace that are uniform, they are ubiquitous, they are everywhere. So, and it goes back to, I think, a place that will surprise a lot of people. When you see it, you'll know exactly what I'm saying. So we're going to look back at a couple of different cases to understand what the markets were saying, and so get a sense from those signals what was going on in each of those periods and how we can use that and adapt that information for where we are today to start to solve the puzzle that we're in, because we're in a very big puzzle. And oh, by the way, as I'll get to toward the end, we've got another big signal here, another hidden signal that not a lot of people talk about or know about, that came up just yesterday. I'll go through that in just a minute. But listen, as far as economics and mainstream is concerned, this is what you hear everywhere. This is all really simple, right? If the Federal Reserve wants to tighten the economy, tighten monetary policy, tighten the monetary system and banking and credit and everything else, and that acts as a braking force on the overall economy, all they need to do is raise rates. Nobody ever asks any question beyond that. Which rates? How are they raising rates? What happens when they do? It's just the Fed raises rates, that tightens the economy. And on the flip side, when they want to loosen, when they want to be accommodative and helpful and supportive, they lower rates. Again, just that generic term, lower rates. Which rates are being lowered? How are they being lowered? Don't ask questions. Just accept that when rates go up, the central bank, the Federal Reserve, is tightening policy and therefore acting as a brake on the economy. And when they lower rates, all the rates go down. That so somehow supports the economy. And there's some intuitive sense that goes along with it, which is one reason why these myths have been so pervasive over the many, many years that they've been offered to the public. In fact, that's the only thing that's offered. So getting people to understand, first of all, just the basics and fundamentals of economics is incredibly difficult when you're given this. And as you'll see, what we're given does not match and line up with reality. So that's why, again, that's the reason why a lot of you are here, is because you realize that we're missing something. We're missing something big because the Fed does this, and the stuff that's supposed to happen doesn't actually happen. So we're going to start with 2008. I think 2008 is a good place to start. Not that we're making direct comparisons here, but 2008 ripped open the veil into the Eurodollar system, but it pulled back the curtain on the Federal Reserve in a lot of different ways. And I'll give you, a story from my own career managing money at the time. A lot of things started to show up in 2005, 2006, and if you're old enough like me, you remember that. People could tell. I mean, it was pretty obvious that the U.S. was experiencing a housing bubble, and it was equally obvious if you were in financial service or had any interest in the monetary system where that bubble was coming from, and you could see how it was spreading around the world. But for most people, trying to explain what we're seeing in, some, not just subprime mortgages, but securitizations and asset-backed securities and CDO squares and all that, it just went right over everybody's head. And again, everybody had accepted and bought into the premise that when the Fed lowered rates, that was loose policy, end of story. Didn't matter anything else. So the 2008, almost immediately, once the crisis hit, it totally exposed this lie in particular. So this is a really good place to start. So I was managing money for people, and I told them, look, there's a lot of stuff that's going wrong. You can probably see in your own life and your own experience that the housing bubble, and you could possibly, game plan how that's going to go, and that's probably not going to go very well. But when you try to put some details behind it, talking about Eurodollar stuff or the inversion of the Eurodollar curve, it just goes over everybody's head. But when you start to get into, short-run interest rates, the very interest rates that the Federal Reserve uses, that's where it really made for a powerful story. And it really started to push back against the mainstream narratives that suddenly became all over the place. And what were those narratives? You probably remember, if you're old enough like me to remember the period, the biggest one that everybody talks about, subprime was contained, right? It's what Ben Bernanke said in 2007, March of 2007. He went in front of Congress and said, look, at this juncture, it seems like subprime is contained. And very quickly, it became very apparent that wasn't true. So that was already one narrative that was exposed by understanding what we're going to go through here in interest rates. The other one was the U.S. economy was never going to suffer any more than a minor slowdown. It was a vibe session. They didn't use that term back then, but there was story after story in the mainstream about how everybody was gloomier than the actual economy seemed. The data didn't seem all that bad. Why is everybody so upset? It must have just been that housing thing. And that was given to them by the same people who thought the Federal Reserve was supporting the economy with loose interest rates or loose interest rate policy by lowering federal funds rate, the Fed funds target. The other one was, okay, if the Federal Reserve is being so loose and then Bear Stearns failed, the Fed came back and responded to Bear Stearns with some of the most powerful stimulus, massive amounts of rate cuts. There was one period in January 2008 where the Fed cut rates by 125 basis points in the span of about 12 days. So that was very powerful stimulus, and it was going to have an effect in the second half of 2008. So that became another narrative that formed in 2008, which was exposed by what was really happening in the market, the hidden truth and secrets the interest rates and interest rate signals sent to us. So Bear Stearns was the bottom. That's what the Fed said. Right away, again, in front of Congress, Ben Bernanke testifies, we did a lot of stuff. Bear Stearns was great. Wasn't great, but we saved Bear Stearns. We saved the system. That's the end of it. We're going to move forward. And then, of course, the last one, which is very familiar to where we are today, inflation, inflation, inflation. And so trying to manage money for people, trying to tell them, look, we have a banking crisis on our hands. We've got deflationary risk. We've got an economy that's likely to end up in a really bad place. If all you have is this mainstream narrative of federal funds rates goes down, that is loose policy supporting the economy, it's very difficult to discern what's really happening because the interest rates were going down. And so if you didn't know the hidden truth behind them, you didn't see beyond all these mainstream narratives. So that's what we're going to do. Like I said, it came up really quickly. To start with, one of the things that you should notice in everything that we're going to go through today is how reality and practice is far more complicated than the story that you're given. Again, the story that we're given is this is very simple and easy, very straightforward. The Fed lowers interest rates, that's positive, that's stimulus, everybody be happy. The Fed raises interest rates, it's because there's inflation, but don't worry, they're going to raise interest rates just enough to stop the economy and therefore stop the inflation. It's all that simple. But then you start looking and asking the questions that I did at the introduction here. What interest rates are being lowered? How are they being lowered? What really happens in these marketplaces? And you start to see behind the veil. It pulls back the curtain by quite a bit. And so right away in 2008, August 9th of 2007, which is the real start date of the crisis, on August 10th, it became much easier for me to be able to explain to my clients, this is what I was telling you about. And at first, it seems counterintuitive because what you're saying is on August 10th, the federal funds rate went down by a lot. And when the federal funds rate went down by a lot, the initial reaction is, oh, that must be good. The Fed responded in some positive way that allowed for interest rates to go down, so we don't have anything to worry about. But then you explain why interest rates went down on August 10th of 2007 after initially rising on August 9th. So the Fed funds rate, the effective rate, went up on August 9th and then down on August 10th. Immediately you think, there's the Fed coming in to act, but the Fed didn't actually do anything. When you look at the dispersion in the federal funds market, first of all, you see, again, these things are far more complicated than you're led to believe. In the federal funds rate, there is no single federal funds rate. There's a federal funds target that the FOMC picks out, and the Federal Reserve vows to try to enforce the target, which you can see it didn't really have a whole lot of luck with after August 9, 2007. So that is the first clue that we have. That everything seemed to work okay before August 9th, and then after August 9th, it starts to get a little chaotic. But the way in which it got chaotic on August 10th really revealed the complexity behind everything. And that is, there were people in the federal funds market who said, I am so afraid of what's happening here. I'm going to lend money in the federal funds market and accept zero return. Zero return, which meant that there were lots of people in the marketplace that were accepting well below the federal funds target as a return. And the reason why was because they knew who was borrowing the funds, and they knew those people borrowing the funds were among the safer variety, less credit risk. So the interest rate in the federal funds market was not falling because of Federal Reserve policy. Instead, it was falling because the market had grown very wary of counterparty risk. And so that was not loose policy picked out by the Fed in order to support an economy and a system that was going wrong. That was the marketplace itself saying, lower interest rates are more complicated than he let you believe. And so it became very easy for me to start to tell clients that, look, this is what's happening in the federal funds market, and here you can see it right on the chart. When lenders in the marketplace are lending at 0% interest rates, or even if it's just 2% interest rates, when the federal funds target is up around 5 and 5.25%, that tells you a high degree of risk aversion in a part of the marketplace that is just where everything starts. And it's where everything starts, and it's supposed to be where everything ends according to the mainstream narrative. The Federal Reserve controls all interest rates. So right away on August 10th, you could see, first of all, the situation in interest rates is a hell of a lot more complicated. And second of all, it raises the question, do they actually control interest rates? And so you could see how that continued on through the rest of 2007 and 2008. The entire time the Federal Reserve, first of all, cut rates in September of 2007 by 50 basis points, did not alleviate the situation whatsoever. The rate cuts by the Fed, all they did was bring the target down toward where the market was already behaving, where it was already acting. So if you're looking at these interest rates from the perspective of the mainstream, you look at the federal funds target from the Fed and think, there's some powerful stimulus by the Federal Reserve. I don't know really how it's stimulus, but that's what everybody says. But when you put the market under the microscope just a little bit, you start to see, first of all, that it's more complicated, and second of all, what looks like it should be accommodative policy is actually the opposite. And when you make that intuitive leap, when you finally get past that point and understand what's happening in the marketplace, suddenly the entire real world opens up to you. So that wasn't the only thing. We also had LIBOR, which was the Eurodollar rate, the offshore rate for US dollar funding. It's sort of the counterpart to federal funds, though not quite. It's in our case here, we'll treat it like that. So on August 9th of 2007, the federal funds effective rate, which is just nothing more than the median weighted average in the federal funds market, that goes up a little bit and then it plunges on August 10th. LIBOR, on the other hand, even though it's the similar unsecured market, at least unsecured out in London, offshore, that one goes up. So from just a surface level perspective, the Fed says we lower rates, that's accommodative, we control rates, everything works really straightforward. So from August 9th and really August 10th of 2007, you had this weird situation where the federal funds effective rate went down, but the LIBOR rate went up. So you have one rate going up and the other rate going down. Suddenly Ben Bernanke's claim that subprime is contained doesn't stand up to even the slightest bit of scrutiny, because you can see it right here visually. Look at the marketplace before August 9th of 2007. Everything was straight, level, there was order to it, there was hierarchy. Once you get to August 9th, whatever you make of interest rates, it's very clear that something isn't right. And so the next thing that we need to understand is not just that it's not so simple as up is restrictive policy and down is loose policy, is that it's not necessarily policy to begin with. And moreover, what really matters more often than not, and more often than you think, more often than you've been told, is order and hierarchy. Because we went from orderly, everything really arranged and everything predictable, hierarchical structure in the marketplace, very neat, very tidy, very predictable, to suddenly chaos, disorder. Some rates are going up, some other rates are going down. So even just looking at this one chart, even if you don't know what LIBOR is, you don't know how the effective federal funds rate is calculated, you can very plainly see, number one, the interest rate story is far more complicated than they tell you, because one rate's going up, the other rate's going down. And number two, it's not contained, because not only is everything more chaotic and disorderly, it is persisting. So if you were paying attention to these interest rates, at the very least, you could say, I don't know what this is, but I know something isn't right because it's right there on the screen. So the interest rate market in the money markets is telling you that something's wrong. Even if you don't know what it is, you don't know what LIBOR is, you can just look at the interest rate and it does not look like the narrative that you're given from economists and central bankers. So when Ben Bernanke said that subprime was contained, I mean, there was already signals in the marketplace that said that wasn't true, but after August 9th and really August 10th, there was no longer a tenable position. Just looking at the federal funds rate itself told you something isn't right. We went from hierarchy and order to chaos and disorder where rates are doing things that they're not supposed to do. At the very least, you say the Fed doesn't look like it's in control of a whole lot here. And of course, I mean, how do you classify that as loose policy when some rates are up and up by a lot and some rates are down, and they're down because the marketplace is growing risk averse and only willing to lend to the safest and most liquid credits in the marketplace. And you can see it continued to go all the way through 2008, right on through the crisis, the entire time. So all of the narratives that we talked about in the introduction of the section, subprime is contained, the U.S. economy is in relatively good shape after Bear Stearns, everything's fine, inflation risk. You could see by the interest rates in money markets, that was not the case. It wasn't true. LIBOR rates were up, federal funds rate more often than not were down. So the Fed, when Ben Bernanke said that Bear Stearns looked like it was going to be the bottom, the Federal Reserve put in all of this powerful stimulus. Okay. Is it, are we back? Yeah. Let's try this again. Okay. We good? All right. Love technical difficulties. Okay, so back to here. So Ben Bernanke said Bear Stearns was going to be the bottom, and right away the market's exposed. That was just not the case. It just wasn't true. You had LIBOR rates that were still going up, and you had federal funds targets that weren't as low as they had been below, or federal funds effective rate that wasn't below. But there was many other signals beside. How about repo rates and treasury bill rates? So again, the point is that you look at these interest rates and you say, look, before August 9, 2007, everything looked relatively calm and orderly, hierarchy. Afterwards, no matter what the Fed did, it didn't seem to make a whole lot of difference. The money markets were staying chaotic and disorderly regardless. So the claim that everything looked to be fine and on the mend was already disproven by what was taking place in the money markets themselves. And of course, when you start digging a little bit deeper at what these rates are actually telling us, I mean, the one thing, T-bill rates were saying, hey, we've got a massive collateral shortage. Again, you don't need to know anything about collateral or shortages to see that something just isn't right there. Especially when we look at repo rates that continue to shallow compared to every other rate, which was another corroborating signal that there was indeed a collateral shortage, that cash lenders in repo couldn't find enough borrowers with the right level, with the right collateral, so they had to take less and less of a return to lend their funds to somebody who had U.S. Treasuries, which is one reason why there was a run into U.S. Treasuries, because that was the only way you could borrow using collateral. So no matter what the Fed did, no matter what the Fed said, just looking at money market rates, we're not even getting into the yield curve or derivative contracts or anything, just looking at money market rates and just inspecting this visually, you can say, everything that I'm hearing in the mainstream cannot possibly be correct, because otherwise things would go back, or at least start to go back to the way they were before. If the Fed was being effective at all in anything that it was doing, then we should see some of this stuff really start to calm down. I mean, in short run periods, yes, a couple weeks here or there, but eventually, the chaos with disorder would start all over again. And you could tell the marketplace is not healing. It's not moving in the right direction. And Ben Bernanke, whatever he's saying, it's just not on the most basic monetary monetary level, it's not coming out. And if it's not coming out in the monetary level, how the hell is it going to come out in the banking sector or the real economy overall? We still have this chaotic monetary system, so it stands to reason that there's more likely than not going to be a chaotic banking situation. And if the banking sector is in chaos, how is the real economy going to be what everybody hoped it would be, which is nothing more than a vibe session, overly gloomy people who were just worried about their housing prices, or otherwise the economy was just fine. So just zooming in on the monetary system and zooming in on money rates themselves, you can see throughout the 2008 crisis that it was a crisis and that the Federal Reserve, what it was doing and what it was saying, was not lining up with reality at all. And like I said, there's so many other corroborating signals out there that you can just take your pick. Another thing I want to point out too is that LIBOR, of course, when Lehman Brothers and AIG really surprisingly, unexpectedly failed in September of 2008, and this is another one, especially managing money through the 2008 crisis. Everybody has it in their mind that, it's sort of like the movies, right? The Big Short, everybody's panicking, everybody's on the phone calling your clients and calling your marketplace to sell, 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 sell. Like the scene in Wall Street where Gordon Gekko's getting the rug pulled. For me, the 2008 crisis was, I don't want to say boring, but it was really boring, because once I was able to show clients what I was talking about, all this Eurodollar stuff that they'd never heard of, all you got to do is show them the money market rates and say, look, this is not supposed to look this way. Something very big is wrong. And if something very big is wrong in the markets, and the markets are showing us that, we should expect very big consequences from it. So when we get to September 2008, like I said, Lehman Brothers was failing. The CNBC was going crazy. Bloomberg, all the financial media channels, the internet back then, it was, blog posts and everything else. Financial news media, they were going crazy. 2008 was pretty easy for me. I had a couple people call me the morning that Lehman Brothers failed, which was a Monday morning, and they called me to say, oh, so this is the big stuff that you were talking about. And I said, yes, and that was basically the end of the conversation. A couple of them asked, well, what are we going to do from here? Which leads me to the next thing and the next set of signals where I made somewhat of a big mistake in not listening to these signals as much as I should have. But the point being is that when you have this information in front of you and it's this clear and this really obvious, it's much easier to make really good decisions about anything. Even if, and this is the part that you keep running across all the time, when you look at this stuff, I can tell you this from experience, it doesn't matter what time period we're talking about, you are swimming against the tide. Everybody says the Fed is loosening policy and is powerful stimulus. If Jay Powell or Ben Bernanke back then said the economy is doing just fine, everybody believes it. And so you have to have something to look at and something solid to analyze and some concrete foundation to go back on that says, am I going to listen to Ben Bernanke or Jay Powell or the financial media? Or do I have something that I know that I can depend upon in which I can make decisions and shut out all that crappy noise that I'm getting from all over the place? That's what this analysis is really doing. It's allowing you to understand what's really happening and to take that information and be able to say, I don't care what CNBC says. I don't care what Ben Bernanke says. I don't care that everybody says the opposite of what I'm thinking, because I know from the marketplace and from these signals that what I'm getting is accurate information. We can always quibble about interpretations and variations interpretations, but in something like this, it is absolutely clear what's really happening. And so you could be confident in your decision making because you have this information in front of you and you know what it actually says, regardless of what anybody else tells you. So one thing I did want to point out is in 2008, during the worst of the meltdown, so after Lehman Brothers and AIG was a big one. After that, LIBOR rates just soared. At the same time, notice short-term money rates like repo and treasury bills and effective federal funds, they plunged. So even in the worst part of 2008, you've got LIBOR rates that are soaring, federal funds rate, and all the other rates that are plunging. And again, you have these widening spreads that tell you, okay, the Fed doesn't really know what's going on. And this only happened many years later. In 2023, the BBC finally did an investigation. I always wondered why LIBOR turned around October 10th, 2008. That didn't really make a whole lot of sense to me. And finally, the BBC filled it in with, it was Andy Verity who did an investigative report. And what they found was that they found evidence that central bankers around the world strong-armed LIBOR participants into lowering their LIBOR rates because they wanted LIBOR to go back down, understanding that the LIBOR was signaling such massive failure across money markets. And so what that tells you is Again, this is the flip side of where we are. Central bankers were not at all confident. They knew that their tactics weren't working. They knew their programs weren't working. They knew that lowering interest rates weren't a powerful stimulus. They knew that all of the other, the primary dealer credit facility, money market facility, and all the other stuff that they came up with, the four-letter acronyms, they knew it wasn't working. They knew their policies weren't loose because they had to get on the phone and basically threaten LIBOR bankers to lower interest rates because their monetary programs were not actually working. We're not actually lowering interest rates. If the Fed was at all a central bank, it would add money to the system that would then circulate and rates would have lowered on their own. So again, it goes to show you what I'm saying here. If the Fed was at all living up to what it's supposed to be, the market would have healed. The system would have shown us concrete signals that things were working. And instead, we got concrete signals of the exact opposite. And now later on, confirmation that the Fed actually knew it too. And you just, one reason they knew it, especially in 2000, I don't want to spend too much time on this, but just one final point. The Fed realized that they had no idea what was really taking place. There was a couple of things that the Fed did during the worst part of the crisis that showed exactly, they had no clue what's going on. It's not just as bad that their policies aren't working. They don't understand the system to begin with, which is something you should always keep in mind. And one reason why we're always swimming against the tide. The Fed doesn't really know what's happening in the monetary system. So they're making proclamations at the very least in the blind and in the dark. So when they say something, everybody believes it. It's one of those things you should immediately think of and immediately consider with a very skeptical look. So the supplementary financing program was meant to try to get the federal funds rate, which was too low, to go back up. And then of course the paying interest on reserves, or what was called IOR back then, and it was changed to IOER, but now it's back to IOR. But both of these tactics were meant to, during the worst crisis, the worst monetary panic since the Great Depression, the Federal Reserve was trying to raise interest rates. So get what I'm saying here. Where we started out was with this narrative and myth that rates go down, that's somehow good. But here we are during a monetary crisis where the Federal Reserve had lost all control of monetary rates and is trying to raise the federal funds rate during the worst part of the crisis. So at the very least, you can take away from this, it is not what they say. And it's not just in the worst parts of the crisis. This happens more frequently, as we'll get into a little bit here. But the point being, at the very least, this is far more complicated than they make it out to be. And the second thing is, you're going to be, when you look and understand what these market signals are saying, you can understand also why everybody behaves the way that they do, including the Federal Reserve. Yes, during the worst crisis since the Great Depression, since the collapse in 1930, the Federal Reserve was trying to raise federal funds rates. Let that sink in a little bit. And of course, there are a lot of other signals that we go through here at Eurodollar University, but they're basically showing you the same thing that we saw in the money market rates. Interest rate swap spreads are a big one. It's one that I continue to come back to all the time. And one of the reasons I do is because this is one of the things that I regret the most from my managing money career. So at the very August 9, 2007, you can very plainly see on the left-hand side of the screen, there's your hierarchy, there's your order, there's everything working the way it should. After August 9, 2007, corroborating the signals that we got from the money market rates themselves, interest rate swap rates, just completely obliterated. There's your chaos, disorder, and everything else. It got so bad that late in 2008, the 30-year interest rate swap spread turned negative for the first time, which was thought to have been impossible, but it turns out it wasn't impossible. And this is where I really regret not listening to my signals. Now, to be fair to myself, at the time, I was still trying to figure out all the various intricacies in the marketplace and the Eurodollar system itself. So I was ready for the 2008 crisis. I was ready for the panic. September, Lehman Brothers, all that stuff. The stock market fell. It crashed in early October. And then I said, well, that looks like that's it. We had our crash. We had the marketplace go. The recession is taking place. Now it's time to start buying stocks and taking risky positions because I think we're at the bottom. There's blood in the streets. Now it's time to buy. And then not long after that happened, that's when the swap spread turned negative. And rather than, I had that intuition. I'm like, okay, you should probably really understand what's happening in the swap market and really having a better handle on why that is. And instead, I thought, Yeah, no, we've got the the downturn in the marketplace. This is probably where it's going to turn higher. And against my better judgment, I didn't listen to the swap market signal, even though the swap market signal is one of the most powerful out there. And again, the point is, at the time, interest rate swaps, to me, it wasn't really clear how they fit into the overall architecture of the Eurodollar system. But after that signal came out and it proved to be correct, that there was another leg down in the marketplace and really the economy, then it was like, okay, I got to go back and really figure out what's happening in the swap market, how it fits into everything, because obviously there's another piece of information that you did not hear anywhere else. I mean, some media stories talked about the interest rate swap spread going negative and how the market was saying the U.S. government was more risky than the financial counterparties on the other side of the swap, which already, that's the nonsense that came out. But for the most part, you didn't hear anything about that. And even better, or worse, depending on your position, the swap market wasn't just talking about the rest of the global monetary crisis. It was also talking about long-run conditions, which sets us up to the next section I'm going to get to in just a minute. But that was one of the biggest regrets that I had, was thinking, okay, we had a handle on the crisis, and seeing this very powerful signal and not realizing the power of that signal because there was so little attention, so little information on it, and not really doing enough homework to figure that out. That's one of the things I regret the most about the 2008 crisis, is being too early on the recovery, because I didn't listen to swaps. It's a mistake I'm never going to make again. That's for sure. But so that's another example of the information that we have that's available, that's very powerful, that you don't get anywhere else, simply because it doesn't make central bank policies look good. In fact, it exposes everything that's wrong with them. So again, what we're taught is that interest rates go down, that's somehow good, and interest rates go up, that's somehow bad. When you can see all over the map, it's at the very least more complicated than that. And in many ways, in fact, most ways, it's the exact opposite. So when you look at all of these various signals, and there's a whole bunch more that I didn't get to, talk about Eurodollar futures, another really good signal. But there was a lot of these signals that said subprime contained. Yeah, I don't think so. This was a Eurodollar crisis, and it had less to do with subprime mortgages than you think. And that's why the markets were continuing to behave in the disorder that they did. A minor slowdown in the economy, that's not what the markets were saying at all. And from the monetary system and all the signals from the banking sector, you can see how that was going to develop into a major, major problem, not just for the US economy, but across the entire landscape. Bear Stearns is the bottom, like I pointed out, with LIBOR versus federal funds. The monetary system itself, just as this front-end money market rates told you, Bear Stearns was not the bottom. We didn't see the type of behavior you would associate with a monetary system that is responding favorably to policies, or even just responding favorably to conditions. Quite the opposite. So when Ben Bernanke said Bear Stearns we think is the bottom, and he wasn't alone. The FOMC discussions from 2008 show this up and down. They all thought Bear Stearns was going to be the end of it, and they could all move on, because they thought inflation was the biggest risk, which the markets all said, no, not a chance. Inflation, it was just a supply shock in oil, and once enough demand was destroyed by the deflation, we were going to have permanent problems. That last part is what the swap market was really saying. So, this is one reason why I tell people to read the 2008 transcripts. What you see validates everything that we said. The markets were behaving in a way that was contrary to what everyone said about everything, and then later on we find out the Fed was just as confused as everyone else. So you should have depended upon these market signals, not these econometric models that these economists use, because they were completely wrong about basically everything from the ground up. So when everybody says these things are happening, we've got all of this information, this wealth of information that's available that tells us whether that's true or whether that's false. And it's something you can depend upon and be confident in your decision making, because you have all of these signals and you actually understand what they really mean. So the next example I'm going to go through is right after this. It's the age of quantitative easing, or as so many people said, the age of inflation, debasement, devaluing, money printing, and everything else that goes along with it. So where you could be confident in your decision making in the 2008 crisis based on the monetary and market signals that we're getting, about deflation in the downturn, you were equally confident in your determinations in 2010, 2011, and moving forward about how it was not money printing, how there wasn't inflation, and how basically everything that everyone said was also incorrect. So in 2008, it really started in 2010, not just 2011, but 2011 is when what we call Eurodollar number 2 really started to erupt in more obvious fashion. But again, just like 2008, you could see it coming as early as 2010, as I'll get to in just a second. So what everybody said by 2010 and 2011 was the economy was recovering. Remember, was it Alan Greenspan who showed up on CNBC or one of the mainstream media channels? This is another thing that was, easier to deal with clients when you could tell them, here's Alan Greenspan on TV talking about green shoots in the middle of 2009, when you could say, well, maybe the economy is not contracting at the same pace, but the markets are telling me this thing is not really recovering. And also notice how recovery is always couched in the language of monetary or really interest rate policies. They talk about the economy being red hot and inflation being overheated. Or, that's the language that we use. So when you talk about inflation risk and money printing, people immediately associate that with a red hot economy because that's what they want you to think. So all of these things tied together in terms of what we're supposed to believe, and they are refuted by all these market signals that tell us that we shouldn't believe what everybody wanted us to believe. The other big one was money printing, right? Quantitative easing was money printing. The Fed was going to use its money printing press, even though it was just buying bonds and creating bank reserves. The sad truth of it is that even to this day, almost 20 years later, nobody knows what the Fed does. Everybody still believes the simple narrative that lowering rates is somehow stimulus and that quantitative easing is somehow money printing. After all, the stock market went higher, didn't it? So again, this is one pervasive narrative that the evidence all showed you wasn't true. And then for all the consequences that came from it, starting with inflation. In 2010 and 2011, because the Fed not only did one QE, it actually did two in 2009, if we're being honest about it. That's how badly it worked, or how badly it failed. They came back with a second or third QE in 2010, and then there were several more beside of it, which already told you it didn't work. But when they did the second QE in 2010, everybody said, oh my God, even more money printing. This is going to be inflationary for sure. Everyone said inflation, especially as consumer prices were accelerating to a small extent due to a supply shock at the time, which again, these monetary signals allowed us to distinguish and really to analyze in more accurate fashion. And of course, with inflation and money printing, the dollar was going to be destroyed. And it wasn't just something that you heard among US domestic mainstream media sources. I mean, the famous example I always come back to is Guido Montiga, who was the finance minister from Brazil, who first used the term, I think it was currency. I think he was the first one to use currency wars in 2010 and 2011 in response to the Fed's QE2, how the dollar was going to go way down and that it was going to be driven down purposefully by Ben Bernanke and his printing press. So that was all, these are what everybody said in 2010 and 2011. So what does the market actually say and what did the information really tell us? Well, straight away in 2010, you can already see, wait a minute, that kind of starts to look like 2008 all over again. Now, it wasn't nearly as big as the spike in LIBOR rates in 2007, 2008, but it shouldn't be happening anyway with the Fed printing money. If there is inflation and economic recovery, we shouldn't see LIBOR behaving the way it did in 2008 at the very least. And then we had all sorts of other signals to go along with it, including how the Federal Reserve itself realized in early 2010, not even a year after the crisis supposedly ended, suddenly we're seeing dollar funding conditions deteriorate. And not just deteriorate a little bit, enough that LIBOR went up. And also we had all sorts of other financial consequences, including, if you remember, the flash crash in stocks on, May 8th, May 5th, early May of 2010. The flash crash in stocks was the liquidity rug pull that related to these Eurodollars. I mean, look at the statement from the FOMC on May 9th. In response to the reemergence of strains in US dollar short-term funding markets in Europe. Dollar strains with QE, global money, in 2010. So already we're seeing the marketplace and these interest rate signals and the information contained in them basically blowing up all of those mainstream narratives about how the economy and the monetary system and inflation and the dollar and everything that followed from it didn't even last into 2010. We also had collateral signals that showed up substantial collateral signals that showed up, especially in early 2011. That was a big one. LIBOR spreads were still relatively high. And then you started to see T-bill rates move down. So again, the money market's information that we were getting suggesting deflation, not inflation. And then the bigger crisis that happened in the middle part of 2011, even though there had been 2 QEs. And this is where it's really valuable to understand what's going on, what these signals are saying, because late 2010 and early 2011, up to around April 2011, is when CPI rates were accelerating the most because there was a supply shock. There was indeed a supply shock in 2010 and 2011, and these monetary signals allowed us to distinguish between what was a supply shock and what everybody said was the inflation that was erupting from all the money printing from the Fed. Again, the monetary system itself said those two things were not happening. The supply shock is going to work itself out, and usually the cure for high prices is high prices. In this case, it was more of a normalization of supply, and then as demand started to really fall off, but you didn't have the monetary situation, you didn't have the money printing, certainly in the Eurodollar system, that would have led to runaway inflation or even sustained inflation. So these monetary signals were incredibly powerful in 2010 and 2011, setting you up for the rest of the 2010s, really the entire decade of the silent depression, because what they said was refuting everything that everybody said in the mainstream. So you had 2 QEs, you had all of these trillions in bank reserves, about 1.6 trillion in excess reserves by the middle of 2011, and it didn't make a difference. It exposed all of the fallacies all at once you knew how to, first of all, calibrate interest rates, but then decode and understand the signals that we were getting from them. And of course, the Federal Reserve was absolutely confused by all of this stuff, just like they were in the middle of 2008, the 2008 crisis, because they don't understand the monetary system. And we'll get to some of an explanation about why that actually is. But it continues to go on from there. I mean, the idea that there was inflationary pressures, inflation was breaking out in 2010 and 2011, refuted not just by the monetary system and money market interest rates. It was also, you could see it in bond yields, interest rates there. Again, the Federal Reserve doesn't control rates. And there's a wealth of information in the behavior of curves and curve spreads that told you there was no inflation risk in the marketplace. The market was not pricing anything like it. And as you can see, interest rates over time are moving lower and lower and lower at the long end, consistent with depression economics, not inflation economics. So you put those two things together where you have the monetary system saying we're seeing real substantial strains in dollar funding conditions in 2010 and 2011, and it continued on into 2012, consistent with deflationary circumstances, not inflationary circumstances, and then longer term rates that respond in kind. So it's a comprehensive picture from top to bottom. And of course, there are other signals too, including interest rate swap spreads. By this time, it was much easier to tell clients about what was really going on because by then they understood the signals that we were getting. Even though every time they turned on CNBC, they heard somebody talking about how inflation was going to soar ahead, how the Federal Reserve was destroying the dollar, how the Fed was printing money, there's going to be hyperinflation. I mean, so many people said hyperinflation. Understood the difference because of all of these market signals that told them what was really taking place at the time. So while the Fed said, there's inflation risk and we continue to get worried about it, the real risk was in deflation and the economic responses to deflation. So there was no money printing, even though everybody said money printing, and you could tell from the very beginning that wasn't the case. Rather than the dollar being destroyed and going to zero, like we've been hearing for the last 18 years, the dollar kind of started to go up in early 2011 and has never really turned around. Yes, there's short-run fluctuations like we've seen in the last couple months this summer, but overall, the dollar has trended higher because it is consistent with all of these interest rates and money market signals that we've been talking about here. So again, understanding the information of interest rates allowed you to understand where the dollar was going to go and not just strictly the U.S. economy and CPI rates. The dollar wasn't doomed. The dollar was never going to be doomed, because that's the information that we got from the interest rate markets. And so, the idea that lower interest rates are somehow loose monetary policy, it just doesn't stand up to scrutiny. And we've seen this in practice, not just from interest rate swaps in the swap market, but all sorts of markets and beyond. Again, The point that we look back in 2008 and 2008 crisis and the aftermath is that it exposed all of these fallacies for what they really are. The idea that loose monetary policy is created through nothing more than low interest rates is completely disproven by very easy to see experience from August 9, 2007 forward. And yet everybody still says all the same things, even here in the 2020s, despite the fact that we see all of this evidence. Well, we have this evidence. That's why it's hidden truth and hidden secrets, is because everybody's still conditioned to believe the Fed. We can move on from this, and we can be confident in our own interpretations because we have access to this information. And more importantly, we know what it actually means. And so it doesn't matter to me what everybody says about QE and money printing. I know the difference. I know the truth. And I understand what the implications are. It sure as hell wasn't hyperinflation. And you can actually see it in the consumer price index or the PCE deflator. We'll use that since that's what the Fed uses. Just in macroeconomic terms, what we would expect is if there was any response from QE, we would expect consumer prices to rise at least a noticeably faster rate in the aftermath of all the quantitative easing. So remember, the quantitative easing kept going all the way through 2013 and 2014. But what you find out instead is, despite the fact and despite the rhetoric, everybody said QE is money printing, it's going to lead to runaway inflation, dollar destruction, even hyperinflation. The 2010s actually averaged substantially less consumer price growth than the Great Moderation. The Great Moderation, that average I'm giving you is only 1992 to 2008. There was much faster consumer prices in the late 1980s. So just giving the benefit of the doubt to the comparison, I mean, 2.2% during one of the most disinflationary periods in economic history, and suddenly, despite the arrival of 5 QEs, maybe 6, depending on how you want to label them, consumer prices average materially less in the entire 2010s anyway, which is exactly what we expected from all of the information that we got from the marketplace, from the monetary interest rates and monetary information right on through yield spreads, the yield curve, interest rates, so more of the esoteric stuff that we get into here at Eurodollar University. But that's the point. You don't even need to get into the esoteric stuff. Just look at some of the more simple things and understand how they run contrary to the mainstream narratives. And so all of those narratives, before we get to that, this is probably one of the biggest ones. This is a chart that I show everybody to see the real economic consequences and just how much QE didn't make a difference. The level of bank reserves completely unrelated to economic circumstances, which is another piece of information, another interpretation of the market signals that we got across the interest rate sectors. They're telling you we should not expect legitimate economic growth, and we should not expect consumer price, we should not expect inflation, we should not expect dollar destruction, because we have depression economics all up and down the entire system. So even in GDP and macroeconomic accounts, especially those like income, you can see how everything performed. There was order and hierarchy before August 2007, and suddenly you have disorder. And in response to that disorder, the Federal Reserve raises the level of bank reserves and lowers its federal funds rate. Not that those are stimulus, but those are just simply responses to the breakdowns in the monetary system that we were warned about and told about from all of these information, all of these interest rate signals and the information that they provide. Bank reserves cannot possibly be money printing because there's no evidence that money was ever printed that made its way out into the real economy. We can have discussions about what bank reserves actually are. One thing that they are not is inflationary. Again, that's the market verdict, and it's been validated through the entire economic history since QE was started, and that goes back to Japan in 2001. So again, mainstream narratives, everybody said the same exact things. The economy's recovered, green shoots from Greenspan. Ben Bernanke's op-ed in was that November of 2010 announcing the second QE. He said, QE's working really well, that's why you have to do it again. It's going to support a recovery. No, that's the market said we were not getting enough jobs. There was too much monetary difficulties. There was too much chaos and disorder in the monetary system as well as the banking sector and therefore the real economy. We were not getting a recovery. And that was the signals we got from all of these different marketplaces. Money printing? No, we kept getting dollar shortages and pretty big ones. Right from the very start, or very nearly the start. You could see this in 2009 heading into 2010, but April and May 2010 with that eruption in repo collateral shortages, no. There was no money printing. Instead, in its place were dollar shortages. So you can see why I'm saying you have to swim against the tide, because everybody's talking about money printing from the Fed when the market is saying Dollars are in short supply, not overabundance. Maybe reserves are overabundant, but that's not the same thing as dollars being available around the entire global marketplace, which is what they really need to. In inflation, nope. There was zero risk of inflation, which is exactly what it turned out to be. Instead, there was disinflation from all of the deflationary monetary conditions and the lack of recovery that the markets were telling you to be prepared for. So everybody was saying inflation, especially in early 2011. You could, if you knew what the markets were saying, you said, no, tune that completely out. This is not going to be, it's not going to be inflationary. It's going to be deflationary, if not a little bit disinflationary. And the dollar down, no, there was no dollar destruction. And there's a couple different reasons there. Some of it is the disinflation. Some of it is the, depression economics. And some of it is just due to the fact that we don't have another reserve currency that's available to pick up the slack from the malfunctioning eurodollar. But the point is, that's what all of these signals were saying, is that the monetary system and therefore the banking sector and therefore the real economy were malfunctioning, even as the Federal Reserve did all of these other things that everybody said were what they really were not. So whatever happened to inflation, the markets told you straight away from 2010, you shouldn't expect any of it to take place. Now, a lot of people, just to take a little bit of a digression here, a lot of people, it's tough to continue to go through this stuff and get to the end of the presentation here without at least spending a couple of minutes talking about how did we get to this point? Where did this come from? How do we get to the idea that we just follow these simple narratives where the Fed says, if I lower the federal funds target, that is somehow accommodation and that is somehow stimulus? Where did that actually come from? Because that's not how central banks worked historically. And there's, of course, an argument to be made, and the one that I make, that central banks never worked historically. But even in theory, that's not how they're supposed to function. Central banks are supposed to supply money to a monetary system that either needs it or take away the money from the system when it has too much. It's not supposed to be targeting short-term interest rates. So where did all of this stuff actually come from? And it came from, first of all, the monetary evolution that's contained in the eurodollar system. So which exposes another one of these big lies. When you line up the federal funds rate and the federal funds target with economic history ever since interest rate targeting was adopted in the early 1980s, you can see how it just doesn't work. Certainly not in the manner that it's intended. So on a very fundamental level, it doesn't work in any way, shape, or form. Forget about LIBOR rates and interest rates and money. Just the unemployment rate versus the federal funds rate and the federal funds target shows you that at the very least we're missing something big. And that's what we're filling in with all the other stuff. But every time we go into a recessionary cycle, unemployment starts to skyrocket or it threatens to skyrocket. The Federal Reserve responds by lowering the federal funds target, and the unemployment rate rises anyway in every single cycle. So from the very beginning, if you looked and paid attention, without any of the market signals, you could say that what the Federal Reserve does cannot possibly be effective. Now, what economists say and central bankers say in response is that, okay, without the lowering of interest rates and the stimulative impact of lower interest rates, it would have been worse. It's the old job save argument that we've heard way too many times over the last really 20 and 30 years. But at the very least, it doesn't work the way it's supposed to. And the reason it doesn't work the way it's supposed to is because it was never supposed to work to begin with. The reason why we get into this interest rate targeting regime in the first place is because the monetary system evolved from the 40s, 50s, 60s on up and left the Federal Reserve behind and out of it. And so I always point to this discussion in the FOMC, among the FOMC policymakers in March of 1991, where they explicitly admitted they're forced to target the federal funds rate because they have no other options. The monetary system evolved, doesn't have a place for the central bank, which means the Fed, as a nominal central bank, has no place to actually intervene in the money supply. So what are they going to do? The Fed said, basically, well, we have no other choice but to try to control the one thing that we at least have some theoretical control over, and that's simply the federal funds target. But as we saw in 2008, even that's tenuous at times too. And Greenspan was not happy about this. You can just read the quote. He did not want to give up on the idea the Fed could do more, but he was forced to do so because the eurodollar had completely evolved many years before then, and there was just no place for the Fed to actually intervene. And there were questions in the media at the time too. If you remember the late 1980s, I was a little bit young for that, but maybe some of you do. People were starting to question what the Federal Reserve actually did, because what it actually did was not what everybody said and what everybody thought it was supposed to do. They seemed to be targeting an interest rate, which is not what central bankers are supposed to do. Central bankers are supposed to target money supply and money characteristics, and that's not what the Fed was doing. And even Tom Meltzer, who was the St. Louis Fed president, he admitted that they were lying about it. Not only were they not happy about having to target a federal funds rate, which didn't really work, they lied about it to the public they lied about it to Congress. In fact, they lied about the existence of FOMC transcripts for 17 years to cover up this fact. And the reason why Greenspan wasn't happy in 1991 about being able to do nothing more than target a federal funds rate was because they tried this in the early 1980s in an informal way in the 1981 recession, and then more formally toward the end of the 81 and 82 recession in 1982. But basically what was the theory behind interest rate targeting was sort of like a phugoid cycle or a negative feedback loop, which was as an economy entered a recession, interest rates would go down, not up, and then as interest rates went down, that would act as a support, sort of a braking mechanism on the economic recession and contraction, because it would stimulate the interest rate sensitive sectors of the economy, which would support the economy and move it back up. So every time the economy went down, so long as interest rates were allowed to go down at some point, or if they were pushed down by the central bank, that would act as support on the economy, and everything would just work out natural and nice. And so as Mr. Wallach said in 1981, he didn't anticipate a severe recession because of this idea that lower interest rates in the marketplace would cushion the blow. Turned out to be very, very wrong, because interest rates did go down and did go down by a lot. And if you know anything about the 81-82 recession, up until 2007, it was the worst one we had experienced since the Great Depression. It would stand that way all the way to 2007. So the idea that lower interest rates somehow supported the economy on their own was immediately disproven by economic practice and economic circumstances, reality, empirical reality. So when Greenspan in 1991, confronting the 1990-91 S&L recession, said, all we can do is lower the federal funds rate, he knew that was not a good place to be, because it had already been shown to be ineffective. But what happened after that? This is where the interest rate targeting idea takes a fortunate turn for the Fed and an unfortunate turn for the entire world. What happened after the 91 recession was the Great Moderation. And the truth of the matter is, nobody knew where the Great Moderation came from. And what happened over the decade of the 1990s on into the middle 2000s is that Federal Reserve officials, in particular, Mr. Ben Bernanke, told everybody the reason why we had a Great Moderation was because they adopted this interest rate targeting scheme, where the Fed moved interest rates down purposefully, and somehow that led to a moderate economic circumstance that was consistently growing, the complete absence of deflationary crisis, which had been all too frequent before the Eurodollar era. But either way, the Fed turned random correlation into causation. The Fed said, we did this. Now, economists, to their credit, actually didn't agree. A lot of economists said, we don't see it that way at all. In fact, the two economists who coined the term Great Moderation said, no, I mean, yeah, maybe policy gets a little bit of credit, but really the reason why this Great Moderation has been so moderate is because we don't see the deflationary breakdowns that we'd seen too frequently. They said it was good luck when the answer was the Eurodollar system. So long as the Eurodollar system was performing, behaving, the Federal Reserve could take credit. As long as the Eurodollar was functioning in hierarchy, in order, in predictability, the Fed could say, we did that. The Eurodollar made the Fed look powerful, and it made its interest rate targeting scheme look legitimate. That's the power of 2007 and 2008, was that as soon as the Eurodollar system broke down, it exposed all of these lies. The Fed had been taking credit for the Great Moderation, and then as soon as we needed the Fed to be what it said it was, suddenly it failed in every single way. No, it was never the Fed to begin with. But because nobody knows the story, and because the Federal Reserve was allowed to take credit for the Great Moderation, it gave this interest rate targeting bullshit the air of legitimacy for a long time. And to this day, people still believe it because they don't know the information that they get from the marketplace. Everybody wants to believe we have these the ideal technocratic philosophers from Plato, that the Federal Reserve, the best and brightest are using all of these expert policies to craft the most optimal economic outcomes, which again is why you never hear about this information from interest rates and interest rate targeting. It's just not there. And they don't want you to know it because it exposes all of these lies. It is utter, complete bullshit. The reason wasn't good luck, it was the eurodollar. So again, when the eurodollar broke down, suddenly the Fed seemed completely powerless because it was powerless the entire time. And maybe that's the biggest takeaway from all of these signals, is that everything that we believed about the Fed is just completely untrue. And then, of course, all of the consequences that have gone forward from it. Which brings us to where we are today. The last couple years have been similar in many ways to everything I just described, in that everybody says all of this stuff over here is happening when the markets have been saying, and all these signals have been saying, no, once again, it's over here and it's all completely different. We are living in the shadow of the 2023 banking crisis, even though hardly anyone knows it. And I'm going to show you exactly what I mean right now, after I get through this, the setup here. So what did everybody say? Inflation, inflation, inflation. That's on everybody's mind. It's all over the mainstream media. The Federal Reserve has been saying the same thing, though they've been forced off of that blind faith in tariff inflation over the last several months due to all of the stuff in the economy that the markets told you to expect. So the Fed says inflation, inflation, inflation. They've been saying the same thing since 2022, when the market said, no, it was a supply shock, just like 2010 and 2011. And the supply shock ended back in 2022. So again, everybody says inflation. You can be confident the markets are telling you that's not the case. Everybody says the U.S. economy especially is in solid footing. Everything's moving in the right direction. It's resilient, especially the labor market. And then more recently, now we're starting to see more confirmation. That wasn't true the entire time, but that's another thing the markets told you, that forgot how to grow, really forgot how to hire economy. Then this is something you hear, especially in cryptocurrency, that's just taken for granted. I mean, why else would Bitcoin be soaring the way it is, right? I mean, it's not like the NASDAQ is soaring too. Oh yeah, the NASDAQ is soaring. But Bitcoin is rising. It has to be rising because the US dollar is being debased, and you hear, oh, fiat currencies are going to go to zero. They're going to completely be destroyed. They're going to destroy themselves. Again, the markets tell you there is no debasement taking place. In fact, the markets tell you it's not fiat currency to begin with. It is a bank-centered ledger system. And then finally, of course, more recently, we've heard the Sell America, though in many ways, that's just a variation on the same themes that we've been hearing ever since QE was introduced in the US in 2008 and 2009. Sell America is nothing more than another reason why interest rates have to skyrocket and the US dollar has to go to zero. And like I said before, all the same signals that we're getting across the marketplace tell you to be confident there is no such thing as Sell America, which is something we're seeing more and more over recent weeks and months. But the point I was really getting at, this what really should be striking here, is the 2023 bank crisis. Now, most people have completely forgotten about it for what should be pretty obvious reasons, is that it didn't seem to lead to anything. The banking crisis didn't lead to a 2008 repeat, not that you should have expected that. You know, we didn't have any more than a couple of banks fail, although everybody forgets about Credit Suisse and focuses on the US regional banks. But let's start here with the Swiss bond curve. The Swiss bond curve stops doing what it was doing right on March 9th of 2023, which is the day Silicon Valley Bank failed. And that valley in the Swiss bond rates is the day after Credit Suisse failed. So in other words, just looking at this, it should be reminiscent of 2007 in this respect. Before 2023, before the banking crisis, the market behaved one way. It wasn't exactly hierarchical and orderly, but it behaved one way. Then we had a banking crisis show up, and very clearly and very visibly, the market behaved very differently. So there's obviously some big implications in the Swiss marketplace related to the aftermath of the 2023 banking crisis. Even though everyone says the banking crisis didn't matter, it's just an interesting little footnote in economic history, the Swiss market says, no, there's something very big about the banking crisis that is lingering on to this very day. And you can see it right here in the Swiss bond curve. And if it was just a Swiss bond curve, you would say this is something like, federal funds rate and what it was doing in August of 2007. This is a big deal. Swiss bond market is a big deal for how it relates to and where it sits in the entire Eurodollar system. But it's not just Switzerland. How about Germany? Germany, the preeminent bond market in Europe. Same damn thing, same timing. March 9th of 2007, in fact, March 9th of 2007, March 9th of 2023, that is when the German two-year Schatzi hit its high. And on March 9th of 2023. Okay, once you could say that's random coincidence. Maybe Switzerland just random coincidence in reaction to the banking crisis, but this is twice now. Swiss bond market, already a big deal because of the importance of the Swiss banking sector and the Eurodollar system. Now we're talking about the preeminent bond market in Europe, in euro denominations. Again, 2023 banking crisis. Whatever you thought before then, something changed the mind of the entire marketplace, that it operated under very different circumstances, very different assumptions and perceptions afterward. Jay Powell and Christine Lagarde said there's nothing to take away from 2023 banking crisis. The Swiss market, the German market, and other European markets say, no, not quite. How about US Treasuries? Yep, same thing. Not quite as visually striking and visually obvious as, say, the Swiss curve, but you can see the entire global bond market said something big changed during that banking crisis in 2023. Again, this is information that you do not hear anywhere else. You do not see this anywhere else. Everybody has said the banking crisis was just, Jay Powell handled it perfectly. There are no implications. There are no consequences. So how in the world can every single bond market on the planet trade and price as if there was something important about that banking crisis, and trade and price in near synchronous fashion? In fact, it really was synchronous fashion, and in exactly the same way afterward. So this is one of those examples where you see how the power of information that comes from interest rate signals that you will not get nor be able to interpret when you listen to what everybody else says. So again, we're confident in our interpretations of what's happening in the marketplace because we understand what these signals say. And putting this into just simple terms, it actually makes more sense, this version of what really happened, than the idea that this major banking crisis showed up. When it showed up, actually didn't make any difference whatsoever. I mean, that should sound like 2007 and all the stuff that Ben Bernanke talked about. It should sound as incredulous as that, because it really is. We had a banking crisis that basically confirmed the deflationary fragility of the Eurodollar system, as well as the banking sector that was hiding a hell of a lot more than just paper losses on US Treasuries. That's the part you never hear about. The banking crisis, like the 2008 crisis, cracked open the window just a little bit so that we could see inside, especially Credit Suisse, and what was really taking place in the banking sector. And even if the economy and the monetary system, the banking sector, didn't fall off in 2008 style right away in 2023, what the markets are telling you here, the hidden information, is that it doesn't matter. The consequences are still going to have to be they're still going to have to be suffered at some point anyway, and that we are still living in the increasingly long shadow of the 2023 banking crisis. And we see this in a lot of different ways too, in a lot of different markets, and they all tell us the same exact thing. Again, inflation, gold prices, everybody think gold is rising because of inflation. Gold is rising because of the same things that we just talked about. There is no inflation. The markets all said it was nothing more than a phase shift in the supply shock. That's exactly what we see in CPI. The record low copper to gold ratio, another signal that you don't get anywhere, and it's another one that corroborates everything that we're seeing from our interest rate signals and from a real economy commodity perspective as well. More hidden signals. Interest rate swaps, I've covered that one enough. I don't really need to go into it here, but it's another, powerful signal that exposes what the monetary system is. And in many ways too, because we don't have LIBOR anymore, we're kind of missing a lot of information that used to be contained in LIBOR. So swaps they're not a perfect substitute. And SOFR, by the way, is not a substitute at all. But we have to look for other ways to find the same level of information. And what the swap market provides is a similar window into circumstances. And the stuff that we talk about in Eurodollar University all the time, the power of interest rate swaps, as I said earlier on in the webinar. And so the interest rate swap market, more hidden information that's not accessible to people who just listen to what Jay Powell says. And this is the one I mentioned in the beginning. The signal we got just yesterday, contango on the WTI futures curve. And that's not just about a supply glut like everybody says. In fact, it's really not about supply. It's about, at the very least, demand for oil, which is consistent with the signals that we've been getting from, the bond markets, the aftermath of the banking system, the banking crisis in 2023, all of it consistent with an oil market that we've seen oil prices fall lower really since 2023 and getting closer and closer and closer into contango, which, as I explained today in a live stream on YouTube, is all about a global downturn signal, not just on supply, not just on demand, but there's also a monetary component with it. So the contango that we're getting in WTI futures is also consistent with this hidden information that we're getting from all over the interest rate markets as well. And there's a lot more information we didn't get a chance to go to here. And the reason why contango is such a powerful signal is when we see the oil curve go into contango, the global economy is usually experiencing a substantial downturn along with, in many cases, starting in 1998, deflationary monetary conditions beside. So again, more hidden information that is beyond and beyond, just completely, you can set aside what these mainstream narratives tell you because these markets and understanding what the markets are saying give you access to information from the marketplaces that are historically validated and far more accurate. So instead of inflation that everybody's been talking about since 2022, the markets, along with the CPI rates, have said, nope, inflation is not a risk, and that includes tariff inflation. As some of the FOMC members are starting to realize, there's zero evidence for tariff inflation because there are no conditions that are conducive for tariff inflation. Solid economy, no. We had the forgot how to hire economy that is suddenly starting to remember how to fire a little bit. We've talked about this. I've talked about this repeatedly, and how all the market signals fit with the transition on the beverage curve. The debasement in currency, no. I mean, again, it's just not there. There's no corroborating evidence for debasement. And in fact, the only reason that people talk about debasement is they have to try to justify a reason why Bitcoin has gone up so much and why it seems to go parabolic. It must be because the dollar is going to zero, right? It can't be because everybody's speculating in Bitcoin. So the rest of the marketplace, the monetary system says it's not about debasement in the dollar system. That's why the dollar is going up again, because it's reminding us that there's a lot more deflationary potential than not. In Sell America, no, there's too many numerous hotspots all over the place. You're not going to see interest rates rise. There's too much demand for safety and liquidity that's consistent with all of these signals, and there's a lot of bubbling up hotspots that we see all over the credit markets, which gets us back to the original question: what exactly is it that the marketplace and all of these bond curves have been pricing in the aftermath of the 2023 bond crisis, or 2023 bank crisis? And the answer is we don't really know yet, but we can also be confident that it's something, because the entire global bond market says you need to pay attention to the aftermath of the 2023 bank crisis, because there is something there that is going to eventually trickle up to the surface and maybe do a hell of a lot more than that. So inflation, no, that's not happening. Dollar debasement, that's not happening. So where that leaves us in the aftermath of the 2023 banking crisis is that we still have some unanswered questions. And so the question I pose to you is, where are you going to find those answers? Are you going to wait for something to happen like 2008 and say, oh, okay, I listened to Jay Powell talk about how everything was great. The Federal Reserve and its models. I mean, what else could the financial media, everybody says that the dollar's going to zero and interest rates have to skyrocket. Are you going to listen to the mainstream and all of those things when they don't have access, when they ignore and dismiss, and even when they do pay attention to the information in the marketplace, they set it aside as, oh, it's just market information. We don't believe in the markets. So you really have a choice. And when you're confident about understanding these signals and being able to interpret all of these signals, you don't care what everybody says about the dollar, what everybody says about inflation, or what everybody says about QE, the Fed, and anything else in between. The information speaks for itself. And over time, what we see in all of these repeated cases is that the world ends up over time. It's not in a short run period, because all of these things are longer processes. They play out over longer periods of time. But over time, the world tends to move in the direction that markets have priced all along, once you understand what these market signals are all about. So it's, what the mainstream media is going to give you is what comes from Jay Powell and Christine Lagarde and econometric models and all of the stuff that has been disproven time and time and time again. And all this information remains hiding in plain sight. It's available, it's accessible to everybody. All you need is a little bit of instruction, a little bit of maintenance and education about how to interpret those signals. But once you see the truth, it is impossible to unsee it. And once you do see the truth, it makes a huge difference in your decision making, whatever that ends up being. Like I said, you could be very confident when everybody is shouting about the dollar it's being debased and it's going to be, it's going to crash. You can understand why it's not going to crash and be confident in making the determination that it's not. Because there's a lot of things that flow through and flow from I can talk. A lot of things that flow from that interpretation. So this is really what Eurodollar University is for. This is one of the reasons why I wanted to do this webinar, because we are sitting at a crossroads right now. If you can't tell, WTI contango sort of coincidentally, but helpfully reminding us of that fact. We are still living in the shadow of the 2023 banking crisis and a whole bunch more beside. So that's what Eurodollar University's mission is. We use the black hole as our logo as sort of an analogy, because one of the reasons why the monetary system remains hidden is because of central bankers and economics. Everything I talked about briefly in that middle section about how they've been trying to cover up the truth, which is the monetary system does not operate the way that you've been told. And more so beyond that, what the Federal Reserve and other central banks have had to do in response is nothing like what they tell you. So economics has done an atrocious job of educating the public on how this stuff actually works, and more so about the accessible information that's available once you know where to look and how to read it. And mainstream sources, huge gaps in everything. If you can't tell, I mean, that's one of the reasons why we went through all of these examples. You can see how it's almost exact, in almost every case, it's almost exactly the opposite of what everyone says. And the reason, as Milton Friedman pointed out back in 2006, is that central bankers set the narratives. Whether you like it or not, it doesn't matter. Central bankers set the narratives, and that's what you're going to hear. Once you realize what it is that the Fed actually does, you can understand why everything flows from that as well, and be prepared about what all that actually means. So what we're doing here at Eurodollar University is trying as much as possible to supply you with all of the information and interpretation and really the tools to be able to do this on your own. You can get my opinions on everything, but once you understand the information and where to access it, how to access it, then once you do that, then the world starts to make sense. And like I said, you become a hell of a lot more confident in your decisions and what you're seeing, because you understand what all this wealth of information, you understand what the information is, what it's telling you, and what it actually means. So that's what Eurodollar University is for. That's what we have our subscription services are all about. And again, it's, what you see in everything that we'll go through and go over here, not just in these examples, but a whole host of other ones beside that we've done in previous webinars, is that there's always this gap. And you see it over and over again. Everybody says this, but the world turns out to do the exact opposite. And so you can adopt that information into any types of strategies that whether it be investment strategies or just understanding where you are, where things are going. Why did the Fed do this and then the market do that? Rather than not being able to provide an answer to, say, clients who you've invested money with, now you'll be able to tell people exactly what's happening and why it's happening, which is a hugely powerful tool, no matter what it is you're trying to do. Because this stuff just isn't random. It all goes back to the same blind spot, which is economics and central bankers. So we have access to the information from this massive Eurodollar system, which is really the reserve currency system that is invisible to most of Wall Street and most of the mainstream public. And this is true. I talk about the swap market all the time, and this is one thing that I would like to give everybody, information about interest rate swaps and how to signal and how to interpret them. But you could talk to professionals, institutional professionals who manage billions of dollars, have never heard of what a swap spread is. It boggles your mind, but once you understand where everything is coming from, it actually does make a lot of sense. And so we have all of these massive gaps to fill, and we have the ability to fill those gaps, which is what we're doing here. As we say, what we're giving you through our Eurodollar University subscription services is access to the control room. Not just all of the signals, but what all the signals actually mean and the consequences that go along with them. So we have the deep dive analysis, which is something I publish every single day, That is, as the name implies, we go deep into these topics. It really is a marriage of current events, what's happening today from the Eurodollar perspective, going deep into these topics, drawing upon either the history or usually a lot of times the history, these former examples, our understanding of the basics and fundamentals from the monetary system on up, basics and fundamentals of interest rates and basic economics, small e economics that you don't get anywhere else. So answering the questions that are definitely circulating in your mind right now. Why did the Fed hike by 500 basis points and then long-term yields didn't actually fell? They're talking about 2004, 2005, 2006, and to an extent, the aftermath of the banking crisis. The Fed continued to hike rates and talk about inflation. Why did the market reject that interpretation? What is it that they're actually telling you? What is it that gold says? How do we get a signal out of that? How do we get information out of that? That's what the deep dive analysis really is. The deep dive analysis goes deep into these topics and really breaks them down so that you understand both where they're coming from and what they actually mean. Also do a daily briefing, which is called the daily briefing, because you need to know what's taking place and what the most important economic data as well as market movements are every single day. This comes out every single day. You know what the Fed says, you know what the financial media says, you know what everybody else says. Now we're going to give you the interpretation. Well, first of all, we're going to tell you what's happening, and we're going to tell you what it actually means and how it fits into the bigger picture. So every day, every evening, you get a detailed snapshot of the most important macroeconomic developments along with the most important market movements, which are often related to how curves are behaving in the short run and how all of these things fit together. Again, it's another powerful piece that's a part of our Eurodollar University control room. Are we seeing stresses building? Are we seeing stresses go away? Is the one thing over here corroborating the other thing over here? That's what you got to have the daily briefing for, especially when in combination with a deep dive analysis. And then our Eurodollar University memberships, we have classroom videos. How do you make sense of all of this stuff? Why didn't QE lead to hyperinflation? What are bank reserves? What role do they actually play? That's a topic or a question that comes up all the time. Well, we've got classroom videos that go into that. If you believe the Federal Reserve prints money, why don't we see any evidence of the money being printed anywhere in the real economy or the monetary system? How does the monetary system actually work? That's what the classroom videos are for, to really give you the background understanding to how all of these things fit together, how to interpret all of these signals, and what they really mean on a deep fundamental level. You've heard about all the textbook answers from economics. You get it all the time in the mainstream media. This is the stuff that you don't get. This is more hidden background information that the economists don't want you to know about because it blows up the entire thing. And if you are new to the Eurodollar, to these concepts, that's no big deal. We have basics videos. In fact, there's 14 of them, and I'm adding more basics videos all the time on these these real fundamental concepts. Like I did a 4-part series in the basics videos on interest rate swaps and interest rate swap spreads. First of all, what is an interest rate swap? You have to understand the contract to understand how powerful it is. Second of all, how do people use interest rate swaps? How do dealers use interest rate swaps? And then, of course, what does swap spread actually tell you? So they're basics videos that goes over the basics in very easy to understand fashion. And then I've got a couple of classroom videos on interest rate swaps that we're going through that goes even farther. So when you have the Eurodollar University control room, you have access to the basics as well as all the more complicated material that goes by. So the basics are incredibly powerful from all of the main, what is QE? What is QT? What are they really? You know what the narratives are, but what are they really? We've got basics videos that got you covered all over there. And when you watch the basics videos, you really do get the light bulb that goes off in your head that says, okay, I finally get it. And once you finally get those basic concepts, then you work your way through the classroom videos to the deep dive analysis, and things really do start to make sense, because not only do you see what's happening, you start to understand why it's happening. You start to understand what it is that people are doing when they engage in interest rate swap. When you see the yield curve move in certain fashions, you understand why it is that people are hedging in a certain way or buying in a certain way or selling in a certain way. That's what the control room is really all about. So you start with the basics and go on. We've got presentations all over the place, on all of the major topics and events that have taken place. The 2019 repo crisis. What was that really about? Not what you think. And it's shocking, right? And not only that, the 2019 repo crisis actually led into the March 2020 crisis itself. Yes, the pandemic and the lockdowns and all that, But there was deflationary monetary signals that came out of the 2019 repo crisis that were very much applicable to March of 2020. So understanding the background behind what happened in 2019 had you prepared for what was going to happen in March of 2020. Yes, pandemic, but it didn't need to get to be that bad, especially in repo markets and collateral. So you've got access to the huge archive of presentation materials that go into these. They're almost like case studies of individual topics. For example, I'm doing a presentation series on collateral. Why do we need so much collateral? Where does it actually come from? Why do we need so much of it? Why does so much of it have to be US Treasuries? Why does it have to circulate? Why does it have to rehypothecate? How can that lead to problems like the 2019 repo crisis? Got you all covered on the presentation archives. Whilst, again, hidden information that you don't see anywhere else. We do live Q&As, pre-recorded Q&As. You can send in your questions. I answer them because a lot of people have individual questions that we don't necessarily get to in a presentation or a classroom video. A lot of people have questions on what they're seeing. Are you seeing the same thing that I'm seeing in these market signals? Here's your opportunity to get to ask me a question about whether or not that I'm seeing the same thing you are, or are you seeing something that I'm not seeing? Or, we can actually have a sort of conversation about, individual needs, individual circumstances, and how that all fits into the Eurodollar University control room. It makes it a little bit more customizable when you're able to interact through the Q&A. A lot of people just like sitting back and hearing other people bring up their questions and see how I answer them and see if it fits with all the other Eurodollar signals and what everybody else is seeing. So that's a huge part of the Eurodollar University control room as well. And then if I'm not available and you want to ask a question from the Eurodollar and get an answer from the Eurodollar University perspective, we have Eurodollar University's AI Search and Insights that is available for deep dive analysis subscribers. So for our webinar offer, you definitely get that part of your subscription here. So if you're seeing something in the middle of the night that's bugging you because a client's going to ask you about this in the morning, you can use Eurodollar University's AI to get an answer in the same vein as I would give you. Not exactly the same because it's AI. Take it with a grain of salt, but it gives you access. It gives you the ability to search through Eurodollar University's information and material in a way that you wouldn't be able to otherwise. So you can get a pretty good answer on whatever it is that's bothering you at any particular moment in time, whether it's day or night. And there is an extensive library for Eurodollar University. Let me tell you, there's a lot of material to go through, a lot of material that you can have access to, and Eurodollar University's AI search makes it a hell of a lot more accessible, which again is the entire point that we're trying to give you here. As much information as possible. We do a weekly recap every week. I put together a weekly recap video that in case you missed something in the deep dive analysis or the daily briefing, you want the week's biggest topics, the biggest developments. There's a video there that comes out every Wednesday that goes through all the biggest stuff there. And again, it cuts through all of the mainstream. No, everybody says this. Well, what do we actually see in any given week? That's what the weekly recap really does. It tells you what happened, why it matters, and what we're going to be watching as we move forward. We have experts. I've interviewed a bunch of people, all the big names that Hugh Hendry, Jim Rickards, one of my favorite. I love Jim Rickards. Mike Green too. I mean, you can't get enough of Mike Green. Lynn Alden's always good to have a conversation with her because we don't necessarily agree on some things. George Gammon, there's a whole lot more. You get access to our experts archive. I'm going to add more as we go forward. And this is stuff that doesn't actually come out on YouTube. This is more private conversations for those who are subscribed. And it's valuable and it's interesting stuff that goes along with, again, our mission here is to provide you as much information and interpretation as we possibly can. This is what these experts are actually seeing and thinking. And I challenge them a little bit to put that in terms of Eurodollar University and Eurodollar knowledge itself. And then there's a couple bonuses beside in this webinar offer. I have a Substack service that goes a little bit deeper than the weekly recaps and some of that, the daily briefing, but not quite so far as the deep dive analysis. So if you want a chunky, beefy, really substantial weekly recap, this is what we have at Substack, and that's included in the subscription as well. I also have different portfolios. They're model portfolios that need to be adjusted probably here in the near term. That tell you about various stages of life, so what I think you should be doing as far as investing your funds, give you some sort of overview and guidelines about what we think from all of these Eurodollar signals, how they apply to investing in markets, whether it be stocks or crypto or a bunch of other things. As much as I bash crypto, I'm actually a very big fan of cryptocurrencies, including Bitcoin. Well, just once you realize what Bitcoin is actually to be used for, and it's not actually a currency. But either way, there's model portfolios that are available for those who are subscribed. I'll tell you where I put my own money, what I'm actually doing, and how these Eurodollar signals and information informs my own analysis and where I'm putting everything that I have. That's in there as well, and it really just. It adds the extra layer to everything, because it's not just what are you seeing, what are you doing? So you have this control panel. What do you do with it? I think it's a helpful overview about where to start thinking about portfolio positioning and investment positioning, and then you can adapt it to your own circumstances, which is another real goal and mission here from Eurodollar University and all these subscriptions, is to be able to take the information, to take the signals, to take the knowledge base and use it for whatever your own purposes are, because there's any number of things across the sun that you could be doing with it. So the summary of everything we got here, we got the deep dive analysis, we've got the daily briefing, we've got the classroom videos, there's a lot of them. There's the basics videos, which are, I think, really necessary. There's the full archive of presentations. We got the live Q&As, pre-recorded Q&As, plus all of the past Q&As. I think we're up to 170 something. So there's a lot of Q&A material. You've got the ability to use Eurodollar University's AI search to get answers from the Eurodollar canon and archives. We've got the weekly recap. We've got expert conversations, and then the bonuses from Substack, the portfolio models and allocations, and my own portfolio as well. And so you add all that up, and it comes out to about 12,000, really almost 13,000 in value, that we're going to give it to you for an annual subscription, not 8,000, not 5,000, but $1,200 annual. So for $1,200 a year, you get access to all of that stuff. You get access to the full and complete Eurodollar University dashboard. You get access to all of the information that you've been missing, the huge gaps that have been left behind by central bankers and economists and economics. What everyone says, you'll be able to evaluate whether or not what everyone says is actually what's taking place in the real world. So $1,200 per year, limited time offer. Use the code that you see on the screen at the checkout page to give you the discounted value, $1,200 per year, access to everything in Eurodollar University, and everything else that we might develop further down the line. You also get access to that. Plus, I'm giving you 100% money-back guarantee, no questions asked for the first 14 days. If you're not completely amazed, it doesn't completely remove all your doubts. Just send me an email. Tell me that you want your money back. I'll make sure that you get your money back. Go through some briefings. Go through some deep dive analysis. Watch some of the classroom videos. Really start watching the basics videos. And if you aren't satisfied after 14 days, let me know. We'll give you your money back completely. No questions asked. Completely guaranteed. And this is a limited time offer, just available for the next 48 hours. So you got to jump on it. Eurodollar University. Eurodollar.university. Make sure you get the. Eurodollar.university/webinar-offer. That's the website. There's a link for it. Use that code to get you the $1,200 per year subscription. So again, it's getting answers. It's getting answers to questions that you all have, that you all really, I mean, you've been thinking about it for a long time, but here's your way, your access to the Eurodollar University control room to be able to finally get those answers, to finally be able to understand all of these missing pieces, why they're missing, what they really mean, and what it means moving forward, especially since, as I said, we still have a major puzzle ahead of us, living in the shadow of the 2023 banking crisis and having all of the stuff that's popping up more recently. I mean, who are you really going to lean on? In times like this, where are you going to get information that you can actually trust? That's what Eurodollar University intends to give you, is everything that you've been missing, and we've got it all together in one convenient control room. So go to eurodollar.university/webinar offer. And by the way, we've also promised to give you access to one of our basics videos. You can do that when you use the code. I think it's basics 11. So it is the introduction to interest rate swaps. And if I don't say so myself, I think it's one of the best videos that we produced. And it's on one of the most important topics that there is. So if you've ever wondered about what an interest rate swap is, and more importantly, why it is so essential and powerful to the operation of the monetary system, the financial system, and everything else beyond, why do we depend so much on the interest rate swap spreads? Here's your chance to start your journey. It's Basics Video 11. All you need to use is code Eurodollar. That's in all caps. It's EURODOLLAR. And I do believe we have a question and answer session. So again, check out our offer, Eurodollar University subscription, $1,200 a year. Get access to everything that we offer. And with that, I think let's start going into the questions. Let me get out of the presentation here. What's happening with oil right now? That's a good question to start with, because oil is in contango. And contango is simply the condition where concerns about demand have gotten to be more than just some kind of future distant properties. Worry. You can. I love technical difficulties. So the oil market is simply saying, look, we know that there's a demand problem. There's a, demand is going to be an issue. Supply is continuing, OPEC is still adding back supply there, but it's really demand that's the bigger issue here. And then we have to consider the fact that contango especially it really brings in financing conditions on top of everything else. And as I said in the live video today, I was really kind of surprised at how fast and how deep the contango really developed over just a couple of days. Now, some of that is, fear of the geopolitics that popped up starting Friday, the tit for tat squabble between China and the United States. But a lot of it is just, hey, we've been moving in this direction for a long time. We get all these other market signals and really monetary conditions that suggest that there's a lot of tightening going on, especially since the payroll report early in August. And so the oil market and participants there is saying, okay, first of all, there's no geopolitical risk is down, so we don't have to worry about the potential for some serious interruptions in global oil supply. That's taken off the table. But the contango is really about looking ahead into next year and seeing very high chance that demand continues to weaken and weaken beyond a whole lot of thresholds. Plus, there's definitely some financing conditions in that as well. So the oil market is basically confirming from a real economy perspective all these other signals that we've been getting all summer. Next question. What's going on with gold at all-time highs? Well, gold, it's not inflation. I know people don't like to say, they never want to hear that. Gold is not about inflation. It's not about the death of the dollar. It's not about fiat currency. Again, that's why I showed you the chart and one of the signals that we get from gold. Gold shows you that it's not about inflation at all. It's really the other side of interest rates. So if US Treasuries are safe havens, which unfortunately they are, I mean, it's not the world that we would like, but that's the world that we have to live in. So US Treasuries are safe havens. So if we see bull steepening on the Treasury curve, that's a sign that there's a lot of demand for safety. In the case of treasuries, it's safety and liquidity, whereas in gold, it's more for safety rather than liquidity because gold is not very liquid. But either way, it's a double whammy for gold because higher demand for safe havens, higher demand for gold, and with interest rates going down on, say, US Treasuries or other government bonds, and when the market perceives that interest rates are going to go down even more in the future and perceives that there's a higher probability that takes place, that lower opportunity cost for owning gold as well. So the real question here is that gold has gone vertical and parabolic since around the middle part of August. Is there something specific? That's really the question I think most people would like to ask. I mean, yeah, we get it safe haven, okay, in very general terms and broad terms. That makes sense, but gold has shot up at a parabolic rate. In fact, it's shot up so fast and so far, it's brought up silver, and it has triggered a supply squeeze in silver. It's got to the point where silver prices are going crazy. And as silver leasing rates as a result have gone crazy, it's now economical to put silver on airplanes and ship it from New York to London because it's gotten to be in short supply. And then India is buying tons of silver too. So the question really is, okay, what is happening in gold in the short run? Are we getting a signal that says something specific is taking place? Now, obviously, we don't know the answer for sure, but if I have to venture a guess, I'm going to say it has a lot to do with credit market cracks that are starting to emerge from things like Tricolor and First Brands, which are really the financial consequences from all of the economics that we've been seeing and saying in the marketplace for the last several years. This may be the final chapter from the 2023 banking crisis. This may be why all of these bond curves, whether it be Switzerland, Germany, France, Italy, the US Treasuries, and a whole lot more beside, why they all changed in their behavior and their nature in March of 2023, because it wasn't about the paper losses the Fed's rate hikes created at Silicon Valley Bank. It was about all the stupid shit that people were doing in 2021 and 2022 that has just been sitting there on the books of all of these banks and shadow banks, which have done even more stupid stuff beside. And so there's a very good possibility that gold is sending us a signal that investors across the world are indeed getting really concerned, not about inflation, not about sell America, but about the final chapter in the 2023 banking crisis. I don't want to oversell it too much here. Let me just finish by saying that's a possibility. And it's one possibility among others, but it seems to be among the more stronger possibilities. We get more information from other sources like, First Brands, what was happening there. There's a lot of corroborating sources that suggest gold may be onto something specific, even if we don't know exactly what it is for sure. But there's definitely something going on in the short run, not just in the long run sense too. Next question. How would the gold signal turn into how would we know if that turns into? Right. So that's where the signals come in from the marketplace. That's where we look around to the signals and say, okay, are we seeing real signs of stress? Not just the there might be some problem here down the road, and we might want to hedge a little bit against it. Where we start to see real extreme positioning, and where do we see that extreme positioning? That's kind of what the question. I mean, gold going higher like that, it's one of those red flags that you say, okay, gold is screaming higher here. Something might be going on, but that's just where you start. I think that's one of the things I probably should have emphasized a little bit more during the webinar is that, we focus on, a money market signal like federal funds. That's not the end all be all. That's not where you end. That's where you just start. Okay, you start to make sense of something here. Does it fit with something over here and over there? And so in many ways, you almost create something like a heat map that says, okay, gold is way up here in the extreme red. What else is in the extreme red beside? And if there isn't a whole lot that is in the extreme red, then you say, okay, maybe it's just the market getting a little bit angsty about, maybe non-specific things. So what you're really doing is looking at one thing and then comparing it to another thing and seeing if you see a whole lot of corroboration where intensity starts to accelerate along with not just these signals. And so gold is an intense signal. And I'll give you a more concrete example in the actual economic or monetary data. Gold matches what we're seeing in the use of foreign assets, U.S. treasuries that are held by foreign official institutions that are held at Federal Reserve Bank of New York in custody. That one is screaming, just like gold. That is suggesting that there's something big going on in the offshore part of the marketplace where foreign institutions are selling or using their reserve assets or U.S. treasuries in some fashion in a big way. I mean, the numbers over the last couple of months are comparable to March of 2020. So you've got gold doing that. You've got the foreign reserve managers using the reserve assets in that way. Those are two really powerful flashing red signals, but we don't see the same types of flashing red signals, not yet anyway, in enough other places that suggest that this is something that's happening right now that we need to pay great attention to is taking place. So there is what it tells you is that gold and this other thing and a couple other ones suggest that there's something going on and it's getting to be pretty serious and something you pay attention to, but it doesn't yet signal that, okay, what we're seeing in First Brands and other places, those are they're definitely going to lead to a financial crisis, which is really a credit crisis, or something beyond it into a liquidity and monetary crisis. We aren't seeing those level of signals yet. So if we start from those and maybe those start to fade a little bit, and so it's another short run indication that doesn't go anywhere because there's a lot of those, But if other things start to flash the same intensity as we see in gold and foreign use of reserve assets, that's when you start to really know or start to really suspect there's something more immediate and concrete going on. One last thing I'll say about this is there's no, this is absolutely happening now and this is taking place. There's no quantitative signal. There's no definitive signal that says this is absolutely the case. What we're doing is we're working in probabilities. And so at the very least, the easiest probability is that all of these market signals say what everybody else says about inflation and debasement and everything else. That's very low probability. In fact, it's almost zero probability. Nothing's ever zero probability, but there's a very low probability. In fact, all the probabilities are moving in the other direction. And so as gold starts to go higher in a short run in really intense way, and then some of these other signals start to become more intense too, that just means the probability of something like a financial crisis or a credit crisis, or even worse, like a liquidity crisis, are going up. The probabilities are going up in that direction. And so when you see the probabilities and see a lot of corroborating signals across the marketplace and in the data that we get and that we follow, that's when you start to really realize that the danger starts to become a little bit more concrete and potentially immediate. That's one of the places you can, okay, is there a place that we can track the data that we look at? Yeah, the Eurodollar University. But if you don't want to use Eurodollar University, which I highly recommend you do, yes, all of the information that I present, with the exception of a couple of things, but all the information that I use is always from publicly available sources, because I want people to be able to, first of all, do their own stuff. Because once you have the knowledge and the ability to interpret all these signals, you want to be able to use the signals. So yes, you can find everything that I do, including interest rate swaps and swap spreads. Everything is publicly available. I mean, specifically, I mean, you can't list everything that we get through, but something like treasury yields, the calculations that go into constant maturities, the Treasury Department publishes those every single day. So if you want to know what the Treasury market's doing, you go to the Treasury Department. One of the ways, or one of the things that the Federal Reserve actually does well is provide some information on collateral conditions. That's what the weekly primary dealers survey is really all about. On a level, the staff level, and to an extent the policy level, central bankers at the Fed do realize that collateral is incredibly important, which is why we have the primary dealer surveys to begin with, even if they don't use it in their own policy considerations. So you can go to the Federal Reserve Bank of New York, which has its own dashboard of all of these various signals that are, whether it be collateral, whether it's the Fed's own reverse repo program, but you just search for the Federal Reserve Bank of New York and its dashboard. It gives you a ton of information there. You can find repo fails on that, which is, repo fails are one of those that can be helpful, and other times it's just, repo fails are fickle, let's put it that way. You can find a lot of information from Fred, just searching through Fred. The data that I just mentioned on foreign reserve assets by FOIs, that's available on Fred, as a bunch of the Federal Reserve information is as well. But it's out there, it's publicly available, and it's accessible. Most of the problem is that people don't know it exists or what it is or how to interpret it, but it's available. The information's available. The most important part is tearing apart everything that you've been learning, everything that you've learned and been taught and told, and starting to rebuild it from scratch. You almost do have to unlearn everything that you learned in school. And so Eurodollar University gives you, first of all, the tools, but also the information and the validation for why you're doing what you're doing, because it actually matches what you can actually see. So the most important part of that, at least the first part of the process, is that once you start to unlearn and tear down all of the, the worldview that you've been handed over time, once you start to tear that down and see the truth, like I said, once you see it, you can't unsee it. And once you do see it, it starts to become your own, your ability to process information, your own knowledge base becomes so much easier, because you don't have these major intuitive hurdles in front of you. And that's one of the big things I encounter all the time from people, is that when you're trying to tell them and explain something, about interest rates, why interest rates, do the exact opposite of what everybody says they do, it's very difficult for people to accept that explanation or even understand the explanation when they're holding on to the mainstream idea, which says the Fed controls interest rates and it prints money, once you let go of those ideas and you really see them deconstructed and put together in a more coherent fashion, what really happens in the monetary system, not only is that powerful information, it also helps you learn on your own because you don't have that baggage. You don't have that, you don't have your feet stuck in cement, which holds you back in a whole bunch of other ways. And that's really why I think one of the most valuable things that Eurodollar University offers is the ability to deconstruct all of those hurdles and then start to put together more useful and usable frameworks for understanding everything moving forward. Asking me questions every week on the live Q&A. Well, I do a live Q&A every other week. You get the link at Eurodollar University, plus we send out emails, a couple emails before the live Q&A. It gives you the link to participate. And once you're at the live Q&A, just type it in the chat. I'll see it. If I see it in the chat, I'll answer it right away. If I don't get to it in the chat, this is why I do a pre-recorded Q&A in between. I try to get to all the questions that are raised in the live Q&A. So that's all you really have to do. We'll give you the email that tells you the link to the Q&A. It's on YouTube. That's where we host it. Just put it in the chat. If I get to it, then I'll answer it as soon as I can. And if not, then I'll get it in a pre-recorded Q&A that comes out every Wednesday with a weekly recap. Okay, no more questions? Let's close this up then. Let's close it up with, look, as I said here, the idea for Eurodollar University is to fill in all of these gaps. And like I've been where you are. I've been struggling with this. I mean, I didn't have anybody to really depend upon. Everything that I did was basically trial and error, and it was an incredibly inefficient and in many ways unproductive process. The example I gave you in the webinar presentation, not trusting my instincts on interest rate swap spreads because I wasn't really sure exactly what it is I was seeing from them, was a big blind spot. It's something that I wish that I had the ability to go back and say, okay, give me some information. So that's what Eurodollar University intends to do here, is to give you as much information as we possibly can, knowing that there are massive gaps that need to be filled. You got to fill in the background, the basics, the fundamentals of basic, small e economics. It really is unlearning everything that you learned in school and what you see on the media. And then giving you not just the signals and the markets and what markets to look for, but also how did we get here? Where did all of this come from? There is massive amounts of economic theory that really needs to be a part of the voyage of discovery that you go on, so that we're going to provide that as well, so that you do have a real comprehensive worldview and background to be able to fall back on. So like I said, the ultimate goal here is so that when you're presented with all of these choices and challenges, you hear all of the noise across the mainstream. Everybody says this, everybody says that. You are supremely confident in what you're seeing and what you're interpreting, even if it flies in the face of everybody and everything. That's what Eurodollar University intends to provide. Regardless of what everybody says, regardless of what you see in the mainstream, regardless of anything. The ability to be confident in your interpretations and analysis so that you can make grounded decisions that you're also very confident in. And that's what we're going to give you as much as possible. And there's a lot of stuff to fill in and a lot available at Eurodollar University. I said it really is a control board that allows you to monitor what's taking place and then put it into useful terms that allows you to be confident in decision making. So I think with that, I think that we're going to end it here. I really appreciate everybody joining me on a Tuesday evening. All you people who are watching on the replays, check out Eurodollar University, our offer, special limited time for basically the entire control board. It's eurodollar.university/webinar-offer. Put in the discount code that's available either in the presentation or it's on the website. It's all available for you. Really appreciate everybody's time. I look forward to seeing you on YouTube and other places. We'll do this again in a couple months because I have a feeling we're going to have to update a lot of the things that we discussed here today. So again, really appreciate everybody showing up today. I'll see you